Speak in English, Mr. Petruzella.
Posterò sulla pagina Moodle tutte le un avviso concernente il retail del precorso, quindi di essere sereno. Metterò il link dell'aula virtuale, metterò le modalità di registrazione.
Va bene. Grazie. Rice?
Sì?
Gli amici qui presenti they didn't listen to what you said because probably the voice was not that loud. So you should say that. One second.
I'm waiting for the confirmation for the administrative offices for the pre-course retake exam of next 15 November, and when they confirm me, I notice on Moodle page of pre-course exam all the details. Don't worry.
Molto bene. Molto bene, grazie. Allora. Okay, so hope that you are okay. We have to go. We agreed before, this morning, to go ahead without any coffee break in the afternoon in exchange for what we're going to leave the room a little bit earlier than 4 p.m. Okay? That was the deal. It made sense to me, so I would keep it. What we were discussing before the coffee break, I'd like to increase the size, okay. What we were discussing before the coffee break was the comparison between the Modigliani-Miller viewpoint and the practitioner's viewpoint. This graph summarizes both viewpoints. With dotted lines, you have the Modigliani-Miller world. The continuous solid lines are on the other side, the practitioners, if I may say, standpoint. Okay? And as you can immediately see, the main difference comes from the fact that according to practitioners, experience shows that the cost of equity capital does not grow that rapid and that fast compared to what the prescriptions of the Modigliani-Miller would say. Okay? And if that's the case, in other words, if they are right and Modigliani-Miller are wrong, let's say it this way, as a consequence, what it used to be a horizontal line RA now becomes a U-shaped curve, the blue line, okay, that has a minimum point somewhere, okay? And what I told you before the coffee break is, what is important for us is to understand the consequences of this difference, okay? The economic and practical consequences of these viewpoints on the capital structure. Let's go back to Modigliani-Miller. According to Modigliani-Miller, no matter what you do with corporate finance, you cannot change the happiness of shareholders, right? So, if you pay or if you don't pay a CFO, doesn't change anything. Actually, if you save money, it's even better, okay? Conversely, according to the practitioner's standpoint, if this is the representation that we should have in front of us, the fact that we have a U-shaped curve, means that there is a minimum point of this curve somewhere, okay? That in turn means that this point, that presumably in this graph is around here, is the point in which the return on assets reaches the minimum level, okay? Reaches the minimum level. And if that's the case, there is also the possibility of, giving a sense to the existence of capital structure, And this sense says that we should aim, we should target our capital structure to a level which corresponds to the minimum rate of return on the assets. So in other words, the objective of the finance function, if practitioner's standpoint holds, is to minimize RA, and we can minimize RA where in this graph we have the minimum point here that in turn corresponds to a certain debt equity ratio. That debt equity ratio is, if we may say, the optimal debt equity ratio that a company should have. So the main consequence between M&M, Modigliani Miller, and practitioner's view is that Modigliani Miller would say that there is no such thing as an optimal capital structure, while on the other side, the practitioner's view, they would say exactly the opposite. In other words, the optimal capital structure does exist, and it can be found, it can be computed, it can be estimated. Okay? And according to this graph is where the U-shaped curve of RA reaches its minimum point. Okay? Okay, that's it. The other slides that you see here are basically a comment on exactly what I was telling you so far. Now, what I want to tell you is that it's an interesting story. The interesting story goes this way. The Modigliani Miller wrote their seminal article in 1958 on American Economic Review. And it was a disruptive article, because if you think about the consequences, if you, Modigliani Miller, are correct, we as companies should rethink the entire modus operandi with which we work, because finance is useless. Well, useless. It's senseless. You don't have to spend a lot of money and efforts in understanding if there is an optimal capital structure, because at the end of the day, you can't make the difference, right? But this conclusion was, how can I say, was disruptive, and was at that time and still today counterintuitive. In other words, you may argue that this is not exactly what actually companies do, because they do care about their capital structure, they do care about their financial strategy. So it means that there's a logical short circuit in the description of Modigliani Miller. Actually, a stream of academics and practitioners started thinking about the implications of Modigliani Miller, and they started working on the Modigliani Miller work. And the rather interesting thing that I always mention, because it is quite peculiar, is that differently from what happens normally in the field of scientific research, what happened in Modigliani Miller case was that they themselves improved their original article. Normally what happens, 99.99 periodical of cases in scientific research, is that Nicolò Nirino writes an article with a very interesting idea, very low probability that this may happen, but okay, with a very interesting probability. Then 6 months later, 1 year later, or whatever later, Francesco Martinelli arrives and builds on top of what Nicolò Nirino improves, and we go ahead this way, right? With Modigliani Miller, this didn't happen, because it wasn't that rapidly and easily understood, the Modigliani Miller world, the implications, and so on. So that's why in 1963, 5 years later, they wrote themselves, in this case on the Journal of Finance, another article improving their 1958 article. Okay, because the rest of the world, 6 billion people, was not able to do better than what they did. They said, okay, don't worry, the rest of humanity we'll do it by ourselves. Okay, that's exactly what happened in 1963, where they wrote another article in which they relaxed one of the assumptions on which their original article was actually built on. And the assumption that they were dealing with was the absence of corporate taxation. In other words, in 1950, all these things that we've seen so far, I hope you have noticed, were based on the fact that there was no taxation. Okay? And there were a lot of comments and critics saying, oh, but this isn't a realistic model, taxes do exist, we should consider them. Okay, that's correct. What happens to your propositions if we include taxes? Will they still hold, or something would change? The article in 1963 answered to these questions. Answers to this question, because the question is only one: the removal of the hypothesis on taxation. More specifically, in 1963, Franco Modigliani and Umberto Milo, they removed the assumption concerning the absence of corporate taxation, not personal taxation, corporate taxation. In other words, they said, what happens to our conclusions if we now assume that corporate taxes do exist? A very interesting question. The possible answers should lie on the following thing. This is always the same picture. Remember, we saw this picture at the beginning of our meeting today. We will move ahead, we will bring forward this picture for the rest of our analysis with different pieces. What happens here is that, in this case, if we include corporate taxation, is that, let's put it this way, the pizza, or the pie, if you prefer, that the company is able to generate is now no longer distributed between two claimants, creditors and shareholders, as we used to do before, you remember? Now it's being distributed between three claimants: tax authority, creditors, and shareholders. So it means that, by definition, this slice that now goes into the into the belly of the tax authority is something that is subtracted from the belly of creditors, okay, but mainly shareholders. Right? So, well, let me put it this way. Some of you may disagree. I personally do perfectly agree with the conclusion, the assumption of Modigliani. They said this is something that companies want to avoid. Companies, wrong. Shareholders of the company, they don't want to share their slice with the tax authority, or they want to reduce as much as possible the slice that goes into the pocket, into the belly of the tax authority. Is it correct? Is it wrong? You know that there is all these consensus, all these movements says taxes isn't a good thing because you're helping the community. Blah blah blah. So, but those who say the opposite to what I'm saying now, they're lying, and they know that they're lying. Companies always struggle to minimize corporate taxes as much as possible. The rest is a blah blah. Greta docet. It's a blah blah. Okay? I've never met an entrepreneur on this planet saying that, yeah, we are happy to share. It even makes me laugh. We're fine. We want to share as much as possible our profits with the tax authority. Never met. And I'm sure that I will never met somebody like that. You may like it or not, but that's the way it goes. Okay? Oh, having said that, if one of the objectives of the firm is to reduce the slice that goes to the tax authority, they should think over it, mumble, and say, what the hell can we do to reduce the taxes? To reduce that white slice. These are three slices. This is the pie. Enterprise value is the pie. These are the three slices. What do you want to do? Reduce the slice of the tax authority. Also because the slice that is called net debt is fixed. You have to repeat, to repay a certain amount of debt. That's it. No matter how many profits you generate, it's a fixed slice. So, if you reduce the slice of the tax authority, and you know that the other one is fixed, the rest goes into your pocket. It means the shareholders, right? Exactly. That's the way it goes. That's the way it goes. Mambo, let me think, let me start. Say, oh wow, Antonio. I have a solution for this incredibly interesting puzzle that you're putting on the table. Really? Yes. You know what? Well, probably Modigliani and Miller went wrong. If we relax the assumption, their original conclusion no longer holds. Why? Because their original conclusion said, now it could be a chorus from you, that no matter if you decide to go with debt or equity, doesn't change the things. But actually, here, the thing changes a lot if you introduce the corporate taxes. But that's the problem. We know that in the overwhelming majority of countries on this planet, when you pay interest expenses, you as a company, you pay interest expenses. These interest expenses, as my colleague in International Financial Reporting Standards has surely taught you, are tax deductible. Dun, 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 dun. I got it. Antonio. Annabelle speaking. Don't go for equity. Finance yourself with debt. Why? This is Antonio. Why? Because you can reduce the tax bill. È vero. You're right, Annabelle. You scared me, but you're right. All other things held equal, it's a ceteris paribus, being like the Arc de Triomphe in Paris. All other things being equal, debt, vis-a-vis equity, financing, has a major advantage. Which one? That the remuneration of creditors, it has interest expenses, are normally, the remuneration is normally tax deductible, which means that if you decide to go and finance yourself with debt, you can have a side effect. And the side effect is a positive one for you because it will help you reducing the white slice named tax authority over there. And this effect is called tax shield scudo of debt. And it is, it's not fiction, it's true. It is exactly the way it works in practice. Companies, let's put it this way. If you are an entrepreneur and you struggle during the night, think and rethink, think over it, I'm squeezing my mind, I need to find a solution in order to reduce the taxes as much as I can, legally speaking. I'm not even mentioning the rest. But legally speaking, one tool in your toolbox that you have for reducing the tax authority bill is to finance yourself with debt, because the remuneration of that will be tax deductible. If that's the case, and we're staying in the Modigliani-Miller world, let's put it this way. The return on the assets, you remember the RA was a flat line, no longer remains a flat line. Now it is a progressively declining, becomes a progressively declining line, due to the fact that the more you borrow, the more you move on the right of this graph, the more you can tax save, and the lower is going to be the rate of return that you provide to that actually is subtracted from the tax authority, which can be put the other way around. That is probably more easy. Please consider that when you introduce the taxes into our framework, it is for a practitioner but also academics, I must say, they no longer speak of RA or whatever. They prefer referring to another acronym which is called WACC, the WACC, weighted average cost of capital. So the probably you have heard already from your Corporate Finance 101 course. The weighted average cost of capital is the RA when in a world with taxes. Okay, yeah, right. The cost of capital is RA in a world with taxes. Okay, and according to Modigliani and Miller, if this steadily decreasing line goes exactly the way it is depicted on the graph, well, the original conclusion of proposition 1, according to which the value of the firm is totally independent of the way you decide to finance your firm, remember proposition 1, no longer holds. Why? Because according to this graph, it would be good for you, company, to position yourself as much as you can on the right of this graph, because by positioning yourself on the right of this graph, you are minimizing the cost of capital. You are minimizing the cost of capital, which in turn, if you go back to Corporate Finance 101 course, it's that you are minimizing the discount rate of the cash flows that you expect to receive in the future. All other things held equal, if you minimize the discount rate given a certain numerator of the NPV formula, you will get a higher NPV. Okay? So, in 1963, they concluded their article saying, if we relax the assumption of non-existing corporate taxes, the conclusion that we reached in 1958, the arrest of the world, is that it no longer holds. It should be changed because the capital structure makes the difference. And the more you borrow, the better the shareholders will be off. And Niccolo is already sleeping. You know the rock band, the Smiths. No, it's during the 80s. Girlfriend in a coma. The text number.
I'm too young.
Eh?
I'm too young.
I go too young. La colpa è. Okay. Now, the one very practical thing. This conclusion is very practical, by the way. There are one consequence of. Well, now let me start from one technical thing, and then we move toward the consequence. Okay. The one thing I want to tell you is, how can we estimate, practically speaking, this tax advantage of debt financing? How the fact that we are saving money, right? Saving money means not giving too much money to the tax authority. For shareholders, it's saving money, okay? How can we estimate these savings, save of money, pragmatically, concretely? There are two possible alternatives in order to estimate the real tax advantage of debt financing. Alternative number one, prevailing in practice, is the following. You add into the formula of the weighted average cost of capital, or if you prefer, the return on assets with taxes. Okay. The 1 minus TC that you see written in red over there, okay, that, as I told you, estimating the delta. So in other words, By adding this 1 minus TC and multiplying it by the rate of return of creditors, financial creditors, you are de facto decreasing RD, right? Because RD is expressed net of taxes. Let's put it this way. Suppose, for simplicity, that I am a company, I knock on the door of a bank, I say, you know what, I need to borrow money. Great. Can you give that amount of money to me? Yeah, sure. How much you need? 10 million euros. Great. Why not? Okay, go for it. 10 million. What is the interest rate that I'm going to pay? For simplicity, 10%. It means 1 million per year. Okay. This is your gross cost of debt, RD. But you already know that if you have the possibility of deducting that million euros interest expenses from your annual taxes, your real net cost of debt is going to be lower. If you deduct the taxes and we call it IRES, in other words, the corporate tax rate is 24%, it means that you have a 240,000 euros advantage, okay, from borrowing money, so that your net cost, the net cost for you is going to be 1 million euros interest expenses net of the 240,000 euros that you're saving on your taxes, which is 760,000 euros, or if you prefer, 7.6%. RD multiplied by 1 minus TC measures the 7.6%. 10% multiplied by 1 minus, in Italy, 24%, it will give you 7.6%. Okay, TC stands for taxes on corporates. That's why it is named with the symbol C. Taxes on corporates. Okay? Second alternative for measuring the tax shield of debt. The first one is this one. The second one is the one presented here. You can estimate the value of the debt tax shield by doing what? By discounting the future tax savings. I will tell you, I'll go into details, don't worry. The future tax savings and appropriately discount them. Sorry. You can discount the future tax savings and sum all of them and get what is your overall advantage that you have. In other words, what I want to tell you is that you can compute. The example I made before, 1 million euro you pay interest rate, but then you have 240,000 euros tax advantage, is a single year calculation, right? But you may reasonably argue that that is going to last longer than 1 year. And if that's the case, you're going to repeat this tax advantage for a certain number of years. In some cases, ideally, you can bring this tax advantage to infinite, provided you earn enough money for paying taxes. Okay? So you may argue that the real overall value of your tax savings is the tax advantage that you have on an annual basis computed for various years. Okay? And the formula that you see over there said explicitly states what I just told you. It says that the present value or current value or the actual value of the tax shields, TS stands for tax shields, is given by the sum of future from next year till a generic n of numerator, the annual tax saving of the interest expenses, divided, that's the denominator, by an appropriate discount rate. The R stands for discount rate. To the power of t, where the power of t reflects the fact that these discount rates should be time weighted according to the years that they are discounted. Okay? If you sum all these future tax advantages, you get the overall value of the package. If you borrow money today, please note that you will have this stream of tax advantage for the next 5-10 years that if you accumulate all these things together and appropriate discount, they have a value of X euros today. Okay. Second simplified version. The second simplified version says that if you add, say, an addition, a couple of additional, actually 3 additional assumptions to the first version that you see over there, you can simplify that formula to the one that you see here. And the assumptions are the following. If the amount, pay attention, don't read that. If the amount of debt is fixed, it means it doesn't change over the years. I mean, with a pinch of salt. Huh? It's more, let's say stable, because fixed seems excessive. Let's say stable. Rather stable, I would say. Second, if that debt is a perpetuity, in other words, it doesn't have any maturity. And third, if you believe that the discount rate that you should use when discounting the future tax savings should be the cost of debt, KD, actually, I don't know why I wrote KD, I'm sorry, but it should be RD, I'm sorry. This is an RD. Oh, no. Oh. And if you assume that the RD is the appropriate discount, and even, I'm sorry, even in the, well, actually, no, we can keep it. All right. Now that we've done it, okay. For consistency with the previous notation. But in any case, you can find your book, for example, is use KD. In other books, is use RD. Be flexible on that. Just if you want to have a possible guide to why do some books use the letter R and other books use the letter K. But, no, I mean, I have one reason in my mind. There are two sides of the same coin. R stands for return. The letter R stands for return. K, that I've not cancelled, stands for cost. Cost of what? Cost of capital. It comes from the German word Kapital. K. What is a return for an investor is a cost for the company. If a company distributes dividends, the dividend is a return for the shareholder, but a cost for the company. So it depends if you adopt ideally the standpoint of companies or the standpoint of investors. By using the letter R, we are wearing the hat of investors. By using the letter K, which is the one used in your book in any case, you are adopting the standpoint of the CFO of the company, but it's the same number, seen from two different angles. Okay? Oh. In any case, if we can introduce, if you're able to introduce, I know that you're now going to fire on the Red Cross. I am the Red Cross. I know. So, but let me conclude and then you can shoot. Okay? If these three assumptions hold, the equation that you see over there can be simplified. Simplified to what you see down here. The present value tax shield is simply the amount of debt multiplied by the tax rate, corporate tax rate. Again, the formula written above can be simplified and you reach the second one that you see down there, which is debt multiplied by the tax rate. Okay, you can now shoot. I'm ready. You want to crucify me or what do you want? I'm available for all experiences. Antonio, what are you referring to what the hell did you have for lunch that you look so? I'm referring to the fact that you may easily argue that these three assumptions that you see over there are totally realistic. A debt which is a perpetuity. In the perpetuity, just to avoid any kind of misunderstanding, perpetuity means that this debt is expected to never expire. What kind of debt is that? I give you the money and I say, it's okay. Let's see on another planet, in another dimension, for repaying the debt. Oh. A debt that is fixed, stable. Oh. The third one probably is the most acceptable, easily acceptable assumption. But the first two, at first glance, may seem totally unrealistic. Irrealistic, sorry. Let me play the devil's advocate role. That's not exactly necessarily the case. Mumble. Could you elaborate, Antonio? Yes, I can. A perpetuity, a debt can be perpetual only also if it is continuously renewed. If the debt has a maturity, but then it becomes renovated, and then it becomes renovated, then it becomes renovated, it's de facto a perpetuity. Not necessarily contractually you have a perpetuity approach or negotiation or agreement, sorry. You can also have a de facto behavior of firms that describe a situation that can be summarized as a perpetuity. So, the second assumption here is check. It's okay. We can have this situation. Short-term debt, bank credit lines, they are continuously renewed. Unless something wrong happens with the company that goes bankrupt, but that's another story. If the company continues as a going concern, going ahead in well and good shape, normally the bank debt is continuously renewed every 3 months, every 6 months, which de facto describe a perpetuity. The one nice thing of finance guys is that they look at the materiality of things. You have been introduced the word of materiality, right? From our colleagues from financial reporting. Busso. Professor Busso surely has told you about materiality of things, right? And in fact, international financial reporting standards, I hope she said that, it's a financial approach. It's entirely finance-based, right? Cash flows, impairment tests, what is that? Finance stolen from accountants. By accountants, sorry. From finance. See, exactly. This is finance stuff stolen by accountants. And what was I saying? Incazzo subito su sta roba. I get mad. Don't get mad. Get even. It's the old saying, right? Don't get angry. Get even. Fixed or stable. A company that has reached the maturity, it's in a mature stage. More or less, it has the same amount of debt in its capital structure. It doesn't change dramatically the amount of debt. So even in this case, especially if a company is mature, we can assume that this assumption is not that strong as it may seem at first glance. So in a lot of circumstances, you can simplify a both formula with the second one, which is much simpler than the first one. Okay? Now, you didn't get, so far, so good. In other words, it's arithmetic, what the hell? You look excited, but you have a problem if you look excited with these things, because they are rather obvious. Actually, what is less obvious is what follows. I'm now sitting with you over there. Antonio? Yes? Do you mind if I ask you a question? I have I would say a major concern. Which one? If what you say, what Modigliani said, what you report from Modigliani is correct, we should observe companies out there 100% debt financed. Because they would like to exploit the tax shield debt as much as they can, like a blob. So that we can bring the tax bill to zero. But this is not what happens. There's a problem somewhere with what you're saying, because the reality shows that the conclusions do not hold in practice. If you say that, I'm dead. I stutter. Yeah, you're right. If we have a problem, think about it. Beh, naturalmente, Franco Modigliani and Merton Miller. Oh, by the way, I forgot to tell you. This is, something that I always mention. If you were, I don't know how to put it because you may misunderstand me. Suppose that you go out for a romantic dinner date. Let's put it this way. No matter which side you are on, and you are exhausting your topics for the dinner. That's a dramatic moment. Especially if it is the first day. No matter if you are a man or a woman or whatever, it's a problem. No, it's no longer my problem, unfortunately, but it could be the problem of no che si puso fidanzato. But by the way, you may have a problem like this somewhere in your life, right? Sometime and you say, oh my God, this is the issue. I'm gonna become boring rapidly. Because if you're trying to feel a little bit attractive and you don't have anything to say at a dinner, you're dead, right? There's no second date. Let me give you one possibility for enriching your romantic dinner. See? Well, now I'm a maschietto, I am a man, and so I quote it from my side. Now you don't always have to specify this at the beginning because people could get offended. So suppose that Antonio Sapi, which is an heterosexual, what do you say? Okay. Said, cara, no, it's too strong. Sweetheart, no. Darling, Annie. You know what? What? I've read somewhere, you never mentioned the fact that the professor told you that. I've read somewhere, there are few cases in the history of science. Stop there because don't go ahead. In the history of science, where the authors of the original idea, the seminal idea, improved the idea by themselves. You have to explain that a little bit better than what I said. You can quote, for example, Albert Einstein. Albert Einstein in 1900 wrote the restricted relativity article, and then a few years later, I don't remember, probably 3 years later, whatever it was, he himself, amazing, wrote another article saying, you know what, forget about that. This is crap. There's a general version of the relativity theory that, if you don't mind, I write it by myself since you're the rest of the world. And it's Albert Einstein, right? There's another case which is Madame Curie in France, and few other cases. One of which is Franco Modigliani and Merton Miller. Honey. Can you believe that? That's crazy. Because they improved the original theory by themselves. It's so rare.
No more.
and she or he depends. There's an happy end. So no, you are the most intelligent and smart and brilliant and attractive person I've ever met on this planet. My heart is open. So that's a good topic for well, depends your counterparty. I mean, sì, c'è qualcosa di meglio. We can say the Maneskin opened the Rolling Stones concert in Las Vegas. That's not a possibility. There's a debate between Maneskin and Cugini di Campagna about because they say they're copying You don't trust me that much. I got it. By the way, that was a problem. Let's go back to Modigliani Miller. Because that's not the end of the story. That's not the end of the story. Because, at least here in Italy, but not only in Italy, I must say, the national sport is to criticize what others have done. Right? Say, oh, you didn't do this correctly, this is wrong. Then if the other says, what do you suggest? It's late, I must go. Something like that, right? People started criticizing this thing, these conclusions. And hey, I'm Franco, but this is not what, this is correct. It makes sense. And it's already a huge conclusion because it helps advisors, it helps private equity investors, it helps companies to estimate the tax advantage, which is something that they couldn't be able to do before that. There's a huge mountain that they've already climbed. But then somebody said, but this is not exactly what we see in practice, because according to this model, we should observe companies which are leveraged up to the tilt. And this is something that we don't observe in practice. What's wrong? You may ask this to your partner. I don't know if you will receive any answer. But in case she or he is particularly smart, she will start by saying, let me think over it. In the meanwhile, you order the second dish. There's something wrong. I have a possible solution. And he or she says, well, one reason could be the fact that you are interested in paying lower taxes if you are profitable. If you're not earning money, you don't pay taxes. Who cares about that financing, right? Your objective is not to minimize taxes, it's to survive, right? So the debt equity puzzle turns back to be irrelevant. Very good. Or there could be another answer from your potential or actual partner that says, waiting for the mistake. One other possibility could be that companies may have other tax shields. What I'm saying is that not necessarily you can reduce the tax bill not only by borrowing more money, you can also use other possible tax shields. A couple of examples, accelerated depreciation. By accelerated depreciation, you increase the annual depreciation, it means that you increase the cost, you reduce the tax bill. Or, another possibility, avoiding capitalizing some of the costs, keeping them in the income statement without shifting them to the balance sheet. Marketing costs, training costs, R&D costs. You keep them if you are able to do that, and if you are entitled to do that by the auditors, you keep them in the income statement, which means that those costs will help you to reduce the tax bill. And if that's the case, you don't need to borrow money to reduce even further the tax bill, because you can exploit this alternative tool. Okay? These are called alternative tax shields. Where is it? And needless to say, of course, there's another thing I was forgetting, the fact that not necessarily the assumptions that we were mentioning before, these ones are always true. I mean these three, especially the first two out of the three, they are not necessarily always true, so in those cases, you may overstate the importance of the tax shield. And that's what your partner says. Then, if she or he has studied corporate finance and knows about the capital structure puzzle saga, which is the saga of Modigliani-Miller saga, it's not yet ended. Because in 1977, 14 years later, Merton Miller alone, in this case, without Franco Modigliani, in order to justify his intelligence, because Merton Miller was much younger than Franco Modigliani at the beginning of their career. So everybody thought, and probably knew that the real guy was Franco Modigliani. Merton Miller only had the brilliancy of selecting the appropriate horse on which to run the race. Okay, that was the male di Cense. The bad thoughts of people out there saying, "Oh, but the real guy is Modigliani Miller. He's an assistant." Like me. The problem is that he hasn't chosen the right horse. That's the problem he has. And so, but that was not the case, because Merton Miller was another very brilliant person. And he wrote alone in 1977 an article relaxing another assumption of their original article of 1958. That's amazing, isn't it? No. It never happens in practice, never. If you could quote me another example, I would appreciate it. I'm not aware of the existence of anything like that. So he wrote another article, in this case alone, removing the assumption of personal taxation, of the absence of personal taxation in the original version, because he said, he dealt with the idea that personal taxes do exist, we should consider them. Personal taxes means individual taxes. In 1963, the assumption that Modigliani and Miller removed was corporate taxes, leaving still there the assumption that personal taxes did not exist. In 1977, Merton Miller alone moved one step beyond, saying, okay, let's also introduce the personal taxes. And to keep a long story short, which is actually reported here, and I will kindly ask you to go through these things alone. If you don't understand, we can go back to that. But let me summarize this long story. The idea is the following. Take a look at me. Don't look at the slide. So everything is fine. How can I put it in the simplest way? Well, let's oversimplify, but it's correct. Suppose we introduce personal taxes. Personal taxes means that if a company finances itself with issuing a bond, okay? A bond is debt that is placed among individual investors. Antonio Salvi, or you, Montano, or Nicolò, or Francesco, we could subscribe these bonds, right? But if we introduce into the analysis the personal taxation, we know that on the interest rate that the bond is giving periodically to us, we're going to pay taxes individually. Okay, correct? Now, what Merton Miller said, and what these slides quantify, okay, with a very simple example. He said something very brilliant. He said, well, but actually, if Antonio Salvi wants to subscribe the bonds of company X, he will formulate in his mind, in his heart, and in his pocket the expected remuneration, a fair remuneration from those bonds in net of taxes terms. You don't fool me, right? If you are a risky company and I want 10%, it's 10% net in my pocket. Not to say, oh, I'm offering you 10%. Okay, bravo. But 50%, for example, goes into the pocket of the tax authority. You know that you're going to receive 5%. That's what's left in your pocket, right? That's what you actually are thinking about. The 5%. You're not so stupid to say, oh, great, I'm getting a 10%. 10%, it's a huge return. Pretending that you ignore the fact that 50% or that 10%, it's not yours. No. the average behavior of investors out there is to think about their strategy, investment strategy, in terms of net of taxes. Oh no. Why do you look skeptical? It's in our DNA. I mean, we believe that people are, on average, rational, right? Rational means that you don't get fooled by the taxes, ignoring their existence. You consider them, and your satisfaction is net of taxes. It's a fact, okay? Now, if that's the case, think about it. What happens to if we introduce the personal taxation? Is that all other things held equal, the rate of return that bond issuers must provide to bondholders is going to be higher, because in a world without personal taxes, I would have expected 5%. Now you're introducing taxes. Since I still do expect 5%, because that's my expected fair remuneration, you must be offering me more, so that net of taxes, I get the 5%. But the fact that you're offering more, it means that you are subtracting cash to the shareholders. So this is a partially counterbalancing effect. You understand what I mean? It is true that you are exploiting the tax, you know that, okay. But still, you're paying a very high interest rate because you need to satisfy net taxes, your bondholders. Okay, but you're paying a lot of interest expenses. You understand what I mean? In Italy would say, la spesa non vale l'impresa. So if you increase, okay, I'm paying less taxes, ho capito, but you are going bankrupt. L'operazione è perfettamente riuscita, ma il paziente è morto. Cioè. You understand what I mean? And that was said by Merton Miller in 1977. Said, it seems a simple story. Actually, it is a simple, intuitive story, but what he wrote, he made this calculation, very simple. Like I was saying, that there is a relative tax advantage of that, considering the personal taxation on dividends or on interest rates that you as an individual may get as an investor, right? You may invest in bonds, you may invest in shares. And what actually occurs to you is that you care about the net flow that you receive, net of taxes, one alternative vis-a-vis the other. And the companies know that, and they will favor what will increase the happiness of their shareholders as much as possible. But that's not the end of the story. Because if you're still waiting for the bistecca, the T-bone in your dinner, and it has not yet arrived, your potential partner would say, yeah, you're right. But there seems something wrong somewhere. It's not enough what you're saying so far to justify the fact that companies don't push on leverage, the accelerator on leverage as expected. Okay? What's wrong here? What is wrong is this. The costs of financial distress. In other words, what happens is that when a company pushes on the accelerator a lot, it means it raises debt excessively, it faces one major, unbelievably important problem. Which one? The fact that the probability of going bankrupt increases exponentially. Okay? And this probability will push companies to not exaggerate, to be cautious as much as they can, and to put, let me say, on a balance, the pros and the cons of debt financing. The major pros, we have seen it. The major pros is the tax shield of debt. But on the other side of the balance, you have the fact that if you exploit too much this advantage of debt, you are paying a price. And the price that you are paying is given by the probability, the increase of the probability of default. Okay? The probability is something may go wrong between the company and its creditors during the life of the outstanding debt. Probability of default, a default reason occurs mainly in three possible circumstances, which are alternative or complementary one to the other. Reason number one for going into a default situation is if you don't pay the interest expenses. Sorry, the interest rate. Alternative number two, which is an and or you don't repay the capital. Alternative number three, which is an and or you breach one of the covenants that are written in your loan contract. You know what a covenant is? If not, I will qualify it. You know what it is? No? A covenant, it's written covenant, literally covenant. It's a financial clause, a clausole contrattuale, that disciplines the behavior of the company / managers, introduced by creditors for protecting themselves against what? Against misbehavior of the company and managers that could be detrimental for their interests. Okay? Example of covenants. Right? There's a loan agreement that says somewhere, my dear company, my dear borrower, which is called the borrower. The borrower cannot decide to merge with another firm unless there's a waiver, there is an acceptance from myself. Okay? Or another clause could be, the borrower will never change its headquarters from where they are to somewhere else. Another clause could be, the borrower will never change its shareholder composition, because that could be well, it's not exactly a case of default, it's an acceleration clause. It means that in that case you need to repay the debt rapidly, without waiting the natural maturity. Or, and these are called the financial covenants, we could, and it's quite frequent today in practice, we could include into the agreement the respect of some financial ratios over the life of the loan. A classical one, net debt over EBITDA. We estimate a ratchet, it's called a ratchet, una griglia, a ratchet that is literally, in some cases even described as a ratchet, that says the first year you cannot exceed this net debt over EBITDA of 5. Second year, 4. The third year, 3. The fourth year, 2, and so on. If you overcome in one of the years these financial covenant that we have agreed with, you will be technically in a breach of a covenant in a state of default. State of default means that creditors, potential, could send you to bankruptcy, basically, because you have not respected one of the clauses. Where bankruptcy is wrong, they could ask normally the acceleration of the repayment, which is a close friend of saying you've gone bankrupt. There's a company in Italy, for example, for which they went bankrupt for an acceleration clause following one breach of a covenant, which is called Cirio. You know Cirio? I'm talking to the Italians, especially Cirio produces tomato, beans, and it's a historical one, right? Probably not everybody here knows that this company went bankrupt 25 years ago, whatever it was, because of a breach of a covenant. Some English institutional investors sent the company into bankruptcy because it didn't respect one covenant. Don't ask me which one, I don't remember. But that was the casus belli. Okay? I'm talking. Dinner is almost over. Could you please tell us? We understand the philosophy behind what you said because that's not complex. However, okay. Scavoli, capperi, per what was I saying? Ledger. Sono distratto un attimo. Antonio. You always stay with your mind when there is a date, right? Because otherwise, you know. Okay, I got this story of the probability of default. But then what happens if there is a higher probability of default? Who cares? This is a warning on the quality of intelligence of your potential partner. Right? If he or she says that, if the probability of default increases, there are a couple of things that may happen at least. Okay. The first one is that the company may incur into the so-called bankruptcy costs. Bankruptcy costs. That, in turn, could be of two types. Direct bankruptcy costs and indirect, depends if you are in UK or US, indirect financial distress costs. What are direct costs and what are indirect costs? Okay? Direct costs are the less boring, the less sexy financial costs, distress costs. They are those costs that companies incur if and when they enter into a bankruptcy procedure. Concordato preventivo, fallimento, Chapter 11, Chapter 7, all these bankruptcy procedures that we have in our countries. When a company enters into this hell corridor, what happens is that a certain percentage of the value of the firm, or the residual value of the firm, is subtracted by the administrative procedure of the bankruptcy. Lawyers, advisors, and all the vultures that fly over a bankruptcy, they can subtract some value from the pockets of which ones? Mainly from the pockets of creditors and shareholders. Why? Because these vultures, they have the privilege of being paid firstly. They are called for the Italians prededucibili, means that they rank first. But if they're not ranked first, it means that banks at least rank second, and shareholders at least rank third. And you have a problem because there is somebody ahead of you in the row. And this somebody ahead of you in the row, in some cases, on average, is a contradiction. So on average, they subtract between 3 to 4 to 5% of the value of the firm, which may sound rather marginal percentage, but actually, if you think about it, what may happen in big bankruptcies like Lehman, like Enron, WorldCom, Ahold, Parmalat, and similar stuff, 3, 4, 5%, it's a lot of money. Lawyers, gli amministratori straordinari, we call them, I don't know how to say it in English, but they earn a lot. I was involved professionally in a rather important bankruptcy of a group located in Bologna that produces, among other things, this is sort of a hobby, sigaro toscano. It's a hobby for them. And it's a big company per se. Imagine the rest. And a branch of this company went bankrupt 6 months ago. And I saw on the report prepared by those, right, that the 3 commissari, we call them, commissari giudiziari, which means the 2 administrative persons charged by the Pre-Ministry of Economics to carry ahead the procedure. They had reserved 3.5 million for themselves, just for one procedure. 3.5 million, it's a lot, individually, yeah? So some persone, let me say it again, because you don't look impressed by anything. I mean, when I saw that, I said, oh my God, this is something I must do definitely, sooner or later, right? Because if you deserve one of these, or you only need one of these, and you're okay. I mean, I'm a humble guy. I can live with 3.5 million for at least for a certain number of years. Then we'll see. 3.5 million years for it's an important group, but not like Enron or Lehman or Wacom. And just to give, so, and by the way, this is not what this is only an example. It gives you the idea that it was 3.5, it was 2.8 million. But it's artificial. Because, where is it? Just to show you some evidence, additional evidence. United Airlines, which is a very important company that has, like Alitalia, has gone repeatedly through bankruptcies, paid a team of over 30 advisor firms an average of 8.6 million per month for legal and professional services related to its Chapter 11 reorganization. Now, think about it, it's a lot of money, it's a lot of money. Enron spent a then record $30 million per month on legal and accounting fees in bankruptcy, with a total cost exceeding $750 million. Wacom, they paid its advisor $620 million as part of its reorganization. Lehman Brothers, all-time hit, $2.2 billion. 2.2 billion is a lot of money, guys. In relative terms, it could be 3%, 4%, 2%, 5%, but in absolute terms, it's a lot of money. But if you mention the direct cost, let me bring the things to the natural conclusion. If this is true, and it is true, so there's evidence, it's legal. I mean, there are some tables, ministerial tables that you follow, and this is what you have to earn. If this is true, and you know that you as a creditor, you know that the company could fall into this trap, well, actually, you will fall into this trap, because you know that 2.2 billion whatever will be subtracted by vultures, and you are the creditor, you remain like, what is your reaction? If there is this possibility that in the future the company may go bankrupt, what is your cynical reaction? Bravo. Say it again. Increase the interest rate, right? But this was something I were commenting Neapolitan. This is one of the defects of Neapolitans. The gesture. I'm sorry. I cannot. It's a problem. So, Tan, what would you do?
Angry.
You would get angry. But don't get angry. Get even. What would you do? You would cut your... What can I throw? Come on. You know it. You increase the interest rate. You increase the interest rate. You're becoming risky to me. Give me a higher interest rate because I may fall into this trap. This is a problem for the company because it starts a vicious circle. Think about it. You are struggling to survive. Creditors know it, and they know that they could fall into the trap. They will ask you an interest rate, and you will have to struggle even more to survive. Let me digress for 1 second. Think about the interest rate from now on when you're adopting the hat of a financial guy or lady. The interest rate as a way of a payback for creditors. If you think about it, you will understand a lot of bank and financial behavior. It's a payback, right? You want interest rate as a payback. There was an Italian economist whose name was Ferdinando Galliani. Galliani was the primo consigliere, the first counselor of Louis XIV, the Roi de France, during the 17th century. Okay, Ferdinando Abate was an abbot. Ferdinando Galliani, Neapolitan, I must say. And he said he used an incredible metaphor, incredible for me, for you could be totally stupid, an incredible metaphor saying that the interest rate is the price of the heartbeat for a banker. And it's true. If you are a banker and you are lending money to a risky borrower, your heartbeat, your anxiety increases, and interest rates are correlated to the heartbeat. The more you are becoming anxious, the more the interest rates are high. Why you are? It's a way of protecting yourself, increasing the interest rate, because you are getting. Let me use an extreme example. Suppose that you are giving the money to a company and you're asking a 20% annual interest rate. It means that in 5 years you will get your money back. You understand what I mean? It's a payback for the borrower. Anyway, in that case, for a company, for a borrower that knows that its client could be problematic, one way for protecting itself is to increase the interest rate in order to shorten the payback period of the lending. But as I told you, the direct costs are everything but sexy. No, Tom? They're not sexy. So vouchers, people subtracting money, in some cases even fraudulent way. Much more intriguing and attractive and sexy are the indirect financial distress costs or bankruptcy costs. Because the indirect costs, they occur even if the company has not yet fallen into a bankruptcy procedure, and in some cases it can even, at the end of the day, never go into bankruptcy. The indirect bankruptcy costs, they show up. They occur if and when a company is perceived by its stakeholders as excessively leveraged. It's the impression that you give to the stakeholders that counts, not necessarily the formal declaration of the court that says you're bankrupt. So the indirect costs of bankruptcy occur earlier than the actual bankruptcy, and in some cases, the bankruptcy never occurs. Think about it. What happens? Now we need to interact a little bit, guys. Come on. What happens when a company is perceived by its stakeholders as excessively leveraged? What are the consequences? In terms of the operating business, what are they? Think about it. They're mentioned here, by the way. What are the consequences? Well, let me break the ice. Well, first of all, I would be tempted to say that if you are excessively leveraged and people, stakeholders, know that you are excessively leveraged, you will lose some clients. You will lose some clients. Why? Because they will be scared that you will never provide the products and the services that you are actually promising to deliver, because you may in the meanwhile go bankrupt. An example, airline companies. I don't know what you do normally, but there are a lot of people out there that have already reserved, and I know it for true, the flights to New York for Christmas 2023. Means 2020 is 2 years. Correct. They have done it already. People are crazy. Probably to save money, to commit themselves to keep the agenda free for the various good. But in 2 years, the airline company could go bankrupt in some cases, right? United Airlines is a classical one. Delta, the same. American Airlines, the same. Alitalia, the same. Air France, the same. Lufthansa, the same. Swiss Air, the same. Sabina, the same. British Airways, the same. There are no airline companies that have not gone, well, actually probably the one from Emirates, but so far have never gone through a major restructuring. Okay? So you may have the fear that from now to 2023, something may go wrong and you may end up never flying. Okay? And if you have that fear, you know what your behavior is going to be. You say, you know what? I need to fly from Milan to New York. What are the carriers that could bring me from Milan to New York? I tell you. There are the former Alitalia, Delta, American Airlines, Emirates, basically. These are the four airline companies. Probably there could be another one, but this for sure there. And suppose for one second that, I don't know, American Airlines, you know that it's struggling to survive. And you know that you're going to fly in 2023. What would you do? You wouldn't choose American Airlines. Say, well, the price more or less is the same. The quality of the airplanes more or less is the same. Wrong, American Airlines are older than others. The quality of captains and the staff and it's more or less the same. Wrong, because if you have ever flown with American Airlines, you know that these guys are crazy. No, è vero. Sono dei pazzi che non fanno. So you say, by the way, suppose that this is correct. You say, no, well, why the hell should I fly with American Airlines? More or less, I'm flying from Milan to New York, I'm going to select Emirates. Because I don't know if with American Airlines. And this fact could bring some airline companies to have a huge loss in revenues. It has been calculated that during one of the dramatic periods of the life of Alitalia, it was 16, 17, something like that, 2016, 2000, quarter to quarter, the first quarter, I remember there was an article in the newspaper that said that Alitalia had lost an estimated a percentage of loss on the tickets sold of around 23-24% because of this effect. They pay attention. I'm not saying that Alitalia has the worst pilots. Actually, it's the opposite. Exactly the opposite. Greek and Italian pilots are the best on the planet. In terms of safety, the fact that they avoid turbulences, they care about the fact that there are people, like me, that whenever there is oh my God, it's over. It's finished. And there are others that I would say that they still continuously, I hate these guys. They continue. They are even better. They feel better. They feel confident, right? With the turbulence. Well, the quality of it. Well, probably the quality of the airplanes of Alitalia was not excellent, but the quality of the staff was very good. Say, and so on and so forth. But actually, they hadn't lost sales because of these factors, because the people didn't like flying with Alitalia. It's because of the fear that Alitalia, a fear which at the end turned out to be true, could never fly again. And you could have lost your ticket. That's exactly what happened to me with a company whose name was Volare Web, with which I bought a ticket from Milan to Napoli 15 years ago, whatever it was. And I'm still waiting to go and see my mother with that ticket, but I have to suspect that I will never be using it. It was 70 euros, it's okay, but I fell into this trap. What was I saying? That's the first consequence, that for a company it is perceived as excessively leveraged. Other consequences. Probably you didn't get it, but there was a question mark at the end. Other consequences?
Banks will not give you money.
Absolutely. No. Exactly. It means that it is going to be difficult for you to ask for additional borrowing. Very good. If I may elaborate on what you were saying, another strongly correlated consequence is the fact that even your suppliers of raw material, spare parts, and work in progress could be suspicious in giving you additional credit, right? So you know what, and this happens on a daily basis till today in Italy. I am one of your suppliers. I need to supply you with aluminium, suppose it's aluminium or whatever for your production process. Okay, I will give it the aluminium to you only if I not my arrivo in your bank, okay? You come down from your building, you give me the money, and I leave. It's not that I leave the aluminium and then you will pay me, will see the bank transfer. No, you pay me cash. That's a problem for a company in some cases. So I totally agree with you. Other possibility?
I would say maybe the financial the KPIs will decrease, like performance ratios, the leverage ratios will decrease.
The leverage ratio, sorry?
It will decrease. Will become more worse.
Exactly.
And it's,
And decreasing means it becomes worse, it means increases.
yeah, it's a bad sign for the investors maybe also.
Well, in general, yeah, you start a vicious circle that if you sell less, if you have a lower credit from your suppliers and from your banks, it is certainly true that you enter into a loop, negative loop, that will decrease the value of equity, and then all other things as equal will increase the leverage ratio of the firm, that in further worsens the situation. Another thing that may happen is the fact that, this is another consequence, you may lose some of your talented employees. In some sectors this is very important. Imagine what happens with pharmaceutical firms. The real asset of pharmaceutical firms is the quality of the researchers, right? The research that you do and the researchers that you use. Some researchers are star researchers, others are dogs, right? And these star researchers, if they have the feeling that the company for which they are working may have a problem somewhere soon, what do? They try the Schettino approach, right? Which is they start sending the CV to other people. They are the first to leave the ship that is sinking, right? Because they can afford doing that, because they are very good researchers. They say, suppose I work for Sanofi, and Sanofi is sinking, and everybody knows, because this is well known in the research field, that you are an incredibly brilliant guy. You start sending the CV to Merck, to Johnson & Johnson, to Bristol Myers, whatever, in order to recycle yourself, and you are the first to leave. Schettino refers to, I'm sorry, this is a little bit blasphemous, so-called blasphemous. Schettino was unfortunately, the captain of the Costa Concordia ship that sank how many years ago? 10 years ago? Something like that. And he, as the good old captain always does, he was the first to leave the ship, which is it's a spot that will never be cancelled from our horror, I must say. Non succede, but it happened. Unfortunately, it happened. Okay, so these stress costs, okay, these indirect, you know, understand why indirect, right? Because they are indirectly linked to the probability that something may go wrong, although this probability has not shown up so far, okay? The direct cost, you are in a bankruptcy procedure. With indirect cost, you could be, who knows, there is some probability that you could go bankrupt, but you're not already in a bankruptcy procedure, okay? And the interesting thing is that these indirect costs have been estimated as well. I don't know if I have, yes. They have been estimated to be around 10 to 20, even more percent of firm value. 10 to 20%, or even more of the firm value. I hope I don't have to convince you that in some cases could be an incredibly huge amount of money that you lose. But let me show you another example. Some years ago, 3 decades ago, 4 decades ago, there was a guy whose name was Lee Iacocca, clear Italian origins, that was in charge of Chrysler in US. He was in charge. Chrysler is like Alitalia. From time to time, it has been going through major restructuring. Finally, it has been taken over by Fiat. But it went to Daimler. First, there was an internal organization. Lee Iacocca was the person in charge, and he estimated that uh, due to the fact that Chrysler was highly indebted at that time, the company had lost around 20%, I don't remember if 20 or 25% of the value of the firm because of this perception that there was in the air that the company could have had some problems. Now imagine what happens with a automobile producer. It happens that what Lee Iacocca was amazed was not that Chrysler produced worse cars than Ford or General Motors or the other classical. What's wrong? I said something wrong? It's not that Chrysler was producing worse cars or the models were ugly. More or less, Chrysler was like the others. Some may prefer Ford, others may prefer. But the market is that, right? And the quality of the cars was absolutely similar. Actually, you may argue that Chrysler had probably even a higher perception of quality among the clients. What he was worried about was the fact that they were losing sales because of something that was not linked to the day-to-day business that they did. It was purely financial. Okay? And that's something weird. I don't know what your opinion is, but it's absolutely weird. The fact that you may lose value increases you may lose value, it pushes company not to increase the leverage as much as they would. Because the more you increase the leverage, the higher is going to be the expected bankruptcy costs. Expected bankruptcy costs, which in turn are the product, as you see here, of the probability of default multiplied by the actual financial distress costs. Okay? It's always a product of how much am I going to suffer in case I encounter some problems, financial distress costs, and what is the probability that I will be these problems. Okay? So the expected bankruptcy cost, as the slide says, can be obtained by multiplying the probability of default by the financial distress cost. Sorry. In terms of our framework of analysis that we have used so far, now I'm using a black color for obvious reasons, the direct costs, the financial distress cost, as we said before, introduce a third slice represented by vouchers. And this is something that you must deal with, hopefully in advance rather than later. Concerning the indirect cost, they may push the company to lose value because the cash flows generated by the firm could be lower because they lose clients, they will pay a higher cost for the supplies of raw material, they lose some employees because of the reasons we were mentioning before that could reasonably push the free cash flows of the firm to a lower level. Okay? What are the implications? The implications of these financial distress costs, bankruptcy costs. The fact that firms that operate in very volatile businesses should use less debt than companies operating in more stable businesses. This is what we would expect and what we actually see in practice. Companies operating in very volatile businesses, all other things are equal, they tend to borrow less money. Second, firms that are able to match the cash inflows from their activity with the cash outflows needed to service the debt outstanding can be able to borrow more, can afford borrowing more. Because I don't want to destroy that beautiful graph that is over there, so I don't want to be blasphemous, but I can show you that tomorrow, because it's linked also to another element. In any case, just even intuitively, you may argue that the company that that is able to structure its financing so that the cash inflows generated by daily activity match, are correlated with the cash outflows, it means that that company can borrow more because it can be able to keep a corridor, a useful corridor, positive corridor that allows the company to avoid any problem of bankruptcy. Companies that on the other side are not able to match the cash inflows with the cash outflows should be more cautious. They should be more cautious and should borrow less. Third, firm whose assets can be easily divisible and marketable can borrow more than other firms. Let me go straight to the point. All other things held equal. This is a quiz that I'm asking you. All other things held equal. Would you expect, for which of these two companies you would expect to borrow more? A real estate company or a pharmaceutical company? Pharmaceutical company. Real estate firm or a pharmaceutical firm?
Real estate.
Per favore rispondete, è troppo semplice questo. All other things held equal, would you expect the real estate company or the pharmaceutical company to have a higher debt in its capital structure?
Real estate. Real estate.
You say real estate. You agree with him? What's your name?
Manuel.
Manuel. Emanuel or Manuel? Emanuel. Pay attention, he said real estate firm. A. Nobody supports the hypothesis of B. You said B, okay. But Max says B. You? What's your name?
Cognome Giulio. Last name Giulio.
And the first one?
Io.
Iole. Bellissimo.
Yeah.
Where are you going?
We have the train, so we
I have a train as well.
can. 20 minutes. So
At what time you have it?
it's 4:13. So
Oh, you have to go.
yeah.
See you tomorrow. Ciao ragazzi. Let's vote in the order that I suggested before. Who votes for a higher leverage for a real estate firm? Wait a second. Uno. Due. I suppose that the others will vote for pharmaceutical. Who votes for pharmaceutical? Let me see the cowards. Who are the cowards? Why are you not answering Mademoiselle on the first row with the white sweater?
I answered.
Which one?
Real estate.
I didn't know this. Sorry.
Yeah.
So 3 for real estate, 10 for pharmaceuticals. Correct? We have a problem. No, perché? Andiamoci. Right. A real estate firm. You don't need to be a finance wizard. And you don't even need to be there. A real estate company. Why? Antonio, why? Annabelle again. Because in case of problems, I said all other things are equal, right? It's a big ceteris paribus. So you must be tolerant on that. In case of problems mean in case of bankruptcy. Let me rephrase, I want to give you another chance. Suppose that the two companies go bankrupt. From which one you do expect as a creditor to receive back more of your initial credit? Real estate! Oh my God! Because you can sell the buildings and at least get part of your money back. With pharmaceutical firms, what do you sell? The microscopes? The vitrine, the bacteria, the viruses, what do you sell? Yeah, you could argue you could sell the patents. True. Ti lancio qualcosa. True. It is true. But there is a problem with opinion. No, it's intangible, immaterial, fluffy stuff. Real estate is real estate. You touch it, you can sell it. You can have an auction tomorrow morning and you sell it. Commercial bankers love tangible assets as a guarantee. And the more you can offer these real estate, so these tangible assets, the more they feel safe, the more you can borrow. And in fact, if you take a look at the actual leverage ratios of pharmaceutical firms, is literally close to zero. While real estate companies is definitely higher than 1. 1 means dead equity, yeah? 1. Let's go home. See you tomorrow, guys, at 12. At noon. We're gonna say hello. At 1, we go for lunch break, and then we're gonna end at 6 o'clock or some little bit earlier. Because I'm sure that you have trained to catch.